it's often survive or die. And I think the ones that did take a realistic approach to valuation, understanding that, it was a pretty aggressive bull run for a while there. They're pretty well placed now to look at a capital markets exit.
You're listening to the Global Workforce Podcast with me, George Britton. Each week, we interview an industry expert to dive deeper into the world of managing a global workforce and discuss the big strategic challenges that you're going to encounter along the way. This episode is brought to you by Omnipresent, the global employment platform that allows you to employ anyone, anywhere without having to set up an entity. Designed, built, and supported by global employment experts, Omnipresent takes care of your international employees and contractors, so you don't have to worry about payroll, HR, or compliance issues, making it easier, faster, and safer to expand internationally. My guests today are two people who bring a wealth of experience in the fields of IPO, venture capital, and cross-border M&A. Michael Jacobs has over 15 years of experience across IPOs, as well as advising on public and private M&A transactions. Michael joined Herbert Smith Freehills in 2020 and is now a corporate partner specializing in equity capital markets, growth capital, and M&A transactions. Michael is a ranked lawyer in Chambers and Partners UK and the Legal 500. He's also qualified and practiced as a lawyer in Hong Kong. Dylan Doran Kennett more recently joined Herbert Smith Freehills to co-lead its venture and growth capital practice. Dylan has a wealth of experience in venture and growth equity transactions, as well as private equity, domestic and cross-border M&A. He predominantly covers the technology, life sciences, media, and sports sectors. Dylan is also a ranked lawyer in the Legal 500 and was named a corporate rising star at the 2023 LMG Life Sciences Awards. Welcome to both of you. I'm really excited to talk to you both today on the Global Workforce Podcast.
Likewise. Thanks, George, very much. Looking forward to this. Thanks for having us.
Same. Thanks very much. Looking forward to it.
Awesome. So let's dive right into some detail. I want to talk a bit about the UK reforms and how they might be able to help UK companies to unlock capital in a more efficient way. We're kind of sitting here recording this in the aftermath of some of these reforms in the UK that came into effect at the end of July, a couple of months ago. They've been designed to make it easier for companies to access capitals. They've been designed to make it easier for companies to access capital. Some of the examples are the new listing rules and the PICES reforms. Michael, I know you've been very positive about these and have got kind of quite a positive perspective on them. I'm keen to get your take on how you think these might help to shape the IPO landscape in the UK.
Yeah, I mean, I think it's kind of no exaggeration to say that this sort of series of reforms are the biggest wholesale change in the UK listing environment for a generation. They are, hugely significant for us to operate in the UK capital market space. So we're obviously very excited about it. And it has changed the tone of the debate on, IPOs in London quite materially. What I would say when you sort of look back, I mean, really the sort of genesis of this, sort of one of the few advantages of Brexit in some ways, because previously we were sort of tied to the EU's minimum directives on prospectuses and that kind of thing. And so one of the sort of flows of Brexit was they did begin with the Lord Hill review and the Austin review and a bunch of other pieces of government commissioned research and recommendations to sort of take a wholesale look at the capital market system in the UK, because I think there was a broad recognition that it really wasn't working as well as it could. And that was a function of, declining number of listed companies in London. It's harder to IPO, perceived attractiveness of other venues being higher, that kind of thing. So, there was a sense of that the sort of standards in the UK were perhaps too high, was creating this kind of walled garden effect where you have lots of, if you look at the composition of the FTSE 100, quite a long tail of, perhaps old economy companies rather than the sort of new growth tech companies that you might want to sort of replenish your indice constituents. So, that was one of the reasons for that, obviously, is the attractiveness of the US as a listing venue. But one of the other main reasons was that the eligibility requirements in London were quite high. You had to have a 3-year track record that was, sort of just profitable track record that was, quite hard for companies to meet, particularly post-COVID. And so there was a wholesale look at the regime, and they've done some very significant reforms. Basically, they want to sort of level the playing field between London and New York. So, for example, you don't need to issue 25% of your share capital on IPO. That's now gone down to 10%, which is broadly equivalent to where it is in New York, although the test is slightly different. But the importance of that is actually from a pricing tension perspective, you want to price your IPO successfully. If you've got to sell 25% of your market cap in one go on IPO, that's quite a lot of lines you need in the book in terms of investors. And so you create some quite, potentially distorted book building exercise, which means the price might not be as high as you hoped, which means you might not get a pop when it IPOs, which means the aftermarket performance might not be as good, which means investors can't necessarily break their lockup and sell down early, that kind of thing. So all of these things have sort of unintended consequences, and particularly when you compare it with New York, who have got the system right, I would say generally. And so what they've done is they've removed all of the eligibility requirements, essentially. So you can be a member of the FTSE 100 without a 3-year track record, without profitability requirements, without necessarily control of your assets, without a clean working capital statement, all that kind of thing. And then they've also scaled back the continuing obligations quite significantly that were real impediments for UK listed companies competing in M&A transactions. So, for example, if a UK company wanted to buy a significant asset overseas, or buy a big US company, for example, to grow its international footprint, if that size of acquisition tripped some tests, which flipped it into what's called a Class 1 acquisition, they'd have to go to shareholders to approve that. And so you would need to basically get shareholder consent in order to execute that transaction, which meant you had to have conditionality in your sale and purchase agreement, which meant UK listed companies were perceived to be not very nimble as compared with private equity. There was almost like a premium put on that risk in terms of the M&A processes. So it was very awkward for companies in that space to do significant transactions. And so that was an impediment to the development of UK PLC in that sense. And so they've scaled back a lot of those eligibility requirements as well to make the kind of listing environment much more benign and attractive. And there's a whole, universe of other things that they're looking at in terms of executive compensation, reporting, governance, stewardship. There's a whole range of things, but the big bang of listing reforms, which took place in July to create this new segment, which is eligible for the FTSE, is, as I said, a huge achievement of the regulators off their cap to them, and the other been, like us, been very involved in promote these reforms. And we think it will result in, a market that is not deregulated, that still has the right level of control, but it's just proportionate and will help encourage companies to list in the future. And it's also, as you might be aware, it's part of a much broader reform agenda that was announced in Management House. So if you think about the reforms I've just talked about there, these are the institutional architecture, the framework, the listing regime that has been recalibrated to make it more competitive. And then that means companies can list, and private equity who has portfolio companies who might be thinking of IPOing have more confidence in the regime. And we can talk about how private equity might think about this. But this is just one part of it. As I said, remuneration is another part of it, but also there's the buy side as well. So there's a big concern that UK pension funds have massively de-equitized, it's called, in terms of so they used to make up between 40 to 60% of the UK stock market. They now make up 3%. In fact, they make up famously less than the GDP weighting if you were to have a global diversified investment plan. The UK pension funds are underweight versus UK GDP versus other countries. If you have which is just absolute insanity. I mean, that is like national suicide, essentially. And that is completely divorced from other markets. And there's been some research published by a think tank called New Financial last week, which demonstrated that, there's a lot more home bias in other markets on the pension side of things. And that affects your buy side. Because you think about why are UK shareholders so willing to sell in a public M&A transaction for a listed company? 60 to 70% of your shareholder register will be non-UK, right? And we'll be thinking about their own financial returns, as all shareholders do. But, if you've got a domestic investor base, they will perhaps think about the national interest and other things like that in terms of creating champions, as they do in other parts of Europe. So I think there's a national security side of this as well, a national resilience side of things, as well as engineering markets on the investor side. And that this involves marshalling pension and insurance money. And there's a lot of talk, various conferences on this topic at the moment about getting those back into equities, both private equity alternatives and public markets, because the core rationale for that is returns for investors need to be improved because there's a massive demographic crisis that's going to hit a lot of the Western countries. And if we don't grapple with that and achieve better returns, like the Canadian pension funds, the Australian pension funds, all have much better returns than UK equivalents, and that affects people's retirement outcomes, which is actually critical. And also this investment provides capital for companies to grow and employ people and the new generation of technologies that we would like to see based in the UK. So like a big UK aspect to this as well. So, the reform is as listing reforms are a key part of that, because you need a kind of clear path to an IPOs which public market investors can invest in. And so anything that is an impediment to that is a real problem and challenge.
Yeah, makes total sense. There's loads of points you made there. I think.
Yes, that was a very,
I loved it.
a very like whistle stop tour of a very big issue, of which there's lots and lots of reports and government studies on, and all that.
And we're both passionate about. So yes.
Yeah, we're very passionate about it. Exactly.
But I think firstly, it's great to be able to point to something and say, actually, part of this is partially unlocked by Brexit. That's good to have at least one benefit of leaving the European Union there, which is good. I think the point you make about only kind of having that minimum threshold dropping from 25% to 10% and allowing companies to kind of dip their toe in the water a little bit, and rather than jumping.
I mean, there's another one which is being consulted at the moment, which is if you are listed and you want to raise new equity capital, which to fund your strategy, to do an M&A transaction, then they're proposing that you won't need to publish a prospectus if you're issuing up to 75% of your share capital. And that is a huge rights issue, potentially a huge capital raise, potentially involving a fundamental change of your business. But removing the prospectus requirement is not without controversy, but if they do, then you would streamline the secondary capital raising process to a matter of weeks rather than months. So if you were a listed company, you wanted to go and buy this US company, not only and use paper as your shares as your consideration, not only do you not now need a shareholder vote, but you won't need to issue a prospectus to issue the shares or raise the money to do that. So it's potentially up to 75%. So that would be, again, a bit of a game-changing and hugely beneficial in one way, but it's obviously not risk-free, because ultimately, all of these things, if you remove eligibility requirements, if you make it everything based on fundamentally around disclosure, what are you saying? You have to make sure that disclosure is right. You have to make sure that you're thinking about the right things and highlighting them. And obviously not everyone has a crystal ball. And so things will inevitably go wrong. And we don't want, which is what happened, which is why we ended up having this massive gold-plated regime in the past, was because of people like Maxwell and other situations, which have resulted in an over-regulated market to sort of remove any downside risk. And we're going back into an era where there is more risk, and risk is a good thing in a capitalist society, but obviously requires people to take their responsibility seriously and make sure they are disclosing what they need to disclose. But as a kind of realignment, it's really great. As I said, it's another fascinating development that consultation actually closes in a couple of weeks' time, debating our response on that with others. But again, that's a very exciting development.
Yeah, absolutely. Dylan, I know you're also really positive about this. Curious to get your take on this as well.
Yeah. Well, I think Mike did a pretty good job covering all the reforms, but On my side, as we see companies go up towards IPO, we're pretty bullish about some of the changes as well too. I think the one that jumps out from my point of view is the dual class share structures. So this is something the US has benefited from for a long time, frankly, in that founders obviously want to retain the control over their company as long as possible. It's their baby, frankly, and any impediment towards that's generally seen as unwise in a founder's mind. But where the US used to stand is, or does stand, is you could have a dual class share structure whereby founders could retain some type of outsized voting control as opposed to the public market who were receiving a different class of share to them. That was something I think they had a leg up on us, and there was an asymmetry there in the UK. That's obviously been introduced, and very excited to have that change over here, because given what the UK has been doing and producing some really domestic amazing champions over the last few years now, and a lot of them coming up to IPO, I think that's going to be quite attractive. Although we did see some issues with some large companies, like tech companies that came through on the first IPO wave, and did take a hit on share price because UK investors maybe weren't as comfortable with that structure or found it as a negative. I think in due course it will just be seen as the common way forward for founder-backed companies. And we hear about things around sunset clauses that might just be for a period of time those dual class shares exist. But for me, I think that one of the discussions we're always having with a late stage company that's looking at exit opportunities, especially when the markets are awash with private capital to stay private much longer, is what are the general benefits of going public, especially if you're ceding that much control. Now that we can say, okay, there is an element of retaining control of the company going forward, that's just another tick in the capital markets box. So yeah, very, very bullish on that side of things. And as Mike touched on in general, adjacently, the Mansion House reforms, very pleased to see that as a Canadian by background. I think I've seen and benefited from what, many of the Canadian pension funds have done over the years. Same with the Aussie Supers. They've just had an allocation always towards, high growth private companies, and there's no reason that shouldn't be done here. So I think we're a bit behind the curve, but I was happy to see that the government was at least going over to Canada to chat with the pension funds, understand how they've set up historically and what their kind of modus operandi is. So maybe we are, I sometimes think that we're a bit insulated in our thinking, but it's good to see that this new government has jumped overseas to take, tips of the trade from elsewhere. So yeah,
I think the Canadians are, done it right. And I think when I looked at the UK regime, and it all across pensions, and insurance, is that, we've inherited something by accident. Really it's evolved over a long time. And things like equitable life blow up and things like that. There's lots of regulation, Solvency II, which is coming from Europe. So we've got this mishmash. It's never been designed. And the systems that have been designed, like the US, Canada, certain Nordic ones, Australia, are incredibly successful in channeling money. And, we've got a huge job to do in consolidating pension funds. There's talk about a national growth fund, new Labour government's announced, but the quantum involved is a rounding error on like the £1 trillion worth of investment the country needs. And we've got the second biggest pool of savings in the world outside the US. It's just all in debt and non-UK equities. So, repivot that would be like amazing. And I think it's going to be a huge job for the government to try and achieve that. And as a pensions review, they've announced explicitly on this topic. So, but if we can learn some stuff from the Canadians and others, that would be amazing. I'd be very much cheerleading that, because it is, it's the sort of existential point I made earlier. There's a big demographic challenge. And then just Dylan, on your point on dual class shares, I completely agree. They're like a kind of litmus test, I think, of how your market, is it founder friendly or is it like investor friendly? And I think having a founder friendly market is absolutely critical, because empirically, and there's been some research done on this by a chap called Professor Bobby Reddy up in Cambridge, and he's looked at all the empirical research. They actually outperform companies without dual class shares for about 10 years, something like that. And so, talk about sunset clauses, have a sunset clause after 10 years if you want, but actually, they look at the evidence, right? And that's because you've got a founder in charge of their strategy, IPOing perhaps earlier than they would. Normally raising money off the equity markets means us three can all invest in them and get the upside. And, they can then execute on their strategy without fear of being taken over, on day one of being listed with a public takeover of that on a price that sort of ticks the boxes of all these sort of pure financial investors. So I think they're, are really good. And the reality is we used to have them in the UK. I think 2/3 of the FTSE used to be composed of companies with some form of dual class share structure at one point. And we've just lost that because of the sort of bias towards one share, one vote and all that kind of thing over the years, and the sort of new premium listing standard that was introduced 12, 25 years ago, 30 years ago. So that's the, we're sort of turning back clock in some ways, which is great. But we shouldn't get away from the fact that dual class shares are, they are controversial because they are a transfer of control. But ultimately, if you disclose it and investors make their decision, why should you regulate to not have them? If people are willing to invest on their basis, so they invest quite happily. So lots of buy side complaining about this kind of stuff in the UK. The purists, but quite happy to invest in Facebook, Meta, Google, News Corp, who have these share rights embedded in them. And some of them have to be unwound. And there's been a couple of things in the UK where investors have pushed back. The Hut Group, which had them in the UK, which had to be standard listed rather than premium listed because you weren't eligible for premium, which means you couldn't get to the FTSE. So that was annoying. It's annoying a lot of founders. So it's, and they've had to unwind them because of investor pressure, but that's the investors' discussions with management and the founders, right? That's how it should be, not ex-ante regulation, which prevents it from happening in the first place, which is just, I think, idiotic in a capitalist society.
Yeah. I guess it comes into the mindset of, as you mentioned earlier, Dylan, you've got a founder with a late stage company looking for a potential liquidity event. Like if you have to cede control with one option, but you don't with another option, it might start to make you think about the trade-off there.
Yeah, especially, as I said, with that large pool of private capital that's sloshing around.
Yeah.
And looking for good investments. Why wouldn't you sometimes? Yeah.
In private equity, they've got a portfolio company, or there's VCs in a, founder-backed company. They don't need to IPO, really. They can hold it forever. If they wanted to, they can do a continuation vehicle. There's a new thing called a private IPO that people are doing. So they don't actually need to exit. They might even do a dual track, which is where you sell either the whole business or do an IPO. So actually, they've got a lot of options. And so you need to make the IPO compelling, from lots of, valuation, liquidity, all these reasons. And, the way the market dynamics work as well on these transactions as well is important. But as Dylan says, it's all private for longer. And that is a huge, theme. So particularly with all the take privates that have happened and the number of listed companies goes down, we have to make the markets look more attractive. And it's not like a zero-sum game. It's not like we all lose if private equity win, because people invest in private equity, have a limited partner. So it's not like that. So, but it should be a continuum in that if a company gets to 20 or 30 billion, which is where the air gets a bit thin for private capital to be able to continue to fund that kind of business. If you look at the market cap of Apple, it's like 3 trillion, private capital can't manage that kind of market capitalization at the moment. Maybe one day, but at the moment, sort of 30 billion is where it gets a bit hard. And so that is appropriate for the public market to take that kind of asset. But the issue has been in terms of the prep for these companies, the readiness for IPO has not been stellar in some situations. And that's why private equity can have a bad, sometimes, reputation of some investors. Unfairly, I think, but it's just the aftermarket performance. Some of these assets is not necessarily a bit stellar. And that has meant that some of these transactions have been, particularly certain vintages like the 2021 IPO vintage, look less well received.
Yeah, 100%. And just to, I guess, underscore some of the points you're making there, Michael, if you look at some of the valuations of, let's say, fintech companies right now, like they're extraordinarily high, but and they haven't listed yet. And you think, well, there's got to be a draw for them to do it, right? Otherwise, what?
Yeah. And there's a mismatch, you have to get people to agree. I mean, today we deal with where the founder has a different idea and valuation to selling to the VCs.
Yeah.
The public markets will have a different perspective because often there's kind of like a discount, there can be a perception that, well, if private equity are selling, why are they selling? And everyone's a bit suspicious of that. And they're thinking, are they selling us a lemon? Which is probably unfair in 99% of the situations. But there is this dynamic which, you kind of have to break to get the market to work functionally. That IPOs need to be the assets need to be well prepared. They need to be with a credible growth story. Ideally there'd be more primary structure rather than secondary, as in new money for the company to invest rather than paying debt that the sponsors have put on to do the buyout in the first place, that kind of thing. So there's a dynamic there, which, because, talking about the difference between New York and London, is European investors are less willing to have leverage on their assets as opposed to the US investors. That kind of, there's things like that, which mean that, this market structure aren't necessarily ideal for sponsor-backed exits, but it's, it's very, I'd say, important that there's like an open dialogue in the way the valuation is discussed, because it's, people have mismatched expectations all the time. And that's why things fall over, right? They do good. And IPOs are a huge amount of work. You don't want to IPO ever, really, if you think you're going to have a situation where you can't ever bridge the gap between the buy side and sellers would.
And that's pretty difficult over the last few years, because we had the pretty heady days of 2020 and 2021, where there was significant capital being pumped into companies at pretty lofty valuations. We've been dealing with the aftermath of that, at least on a private basis, in that, valuations have been taking a haircut over the last couple of years with the recessionary pressures that we've been facing. But if you do have those companies who are still late stage companies at a very high valuation, and, looking at an IPO might result in a bit of a haircut to valuation, it's a tough discussion to be having, but there still remains that element of prestige to be a public market company. And, over the long term, you're assuming that market cap's just going to flow upwards over time, provided the company performs. But there is that initial, as Mike says, that initial gap to bridge and where we are on valuation. So, everybody needs to be rowing in the same direction at that point.
And there's a bit of, Dylan, what's your take on private, VC valuations? Because some of the things I see is not necessarily a valuation. It's more, the company needs this much money to survive the next 18 months, and it's willing to give 10% of equity and a board seat for that. And it's like the valuation is like a mathematical
Function.
Function of that. And, maybe when you've got a revenue track record, you can do a proper discounted cash flow and, evaluate, look at the EBITDA and all that kind of stuff. But there is some voodoo stuff going on there, I think.
I think that's maybe the right way of looking at it. It is more of an art than a science until we get into the later stage rounds, and then people will start really kicking the tires, on ARR and multiples thereof, perhaps if it's a SaaS business. So there will be some pretty hard discussions, and we did see that during, the last couple of years, to just, have these reflect reality. And, I've been on a number of calls where investors were saying, capital markets are doing X for this category or this sector, and you're asking me to invest at Y. It just doesn't make sense. So I think with the capital markets coming down, that at least brought a lot of the valuations down where they needed to be in a lot of private rounds. We didn't hear announcements about them or anything, but some companies have readjusted during that phase, and it's probably to their benefit over the long term, frankly. Because I guess what we noted is the founders that really dug their heels in and, pushed to retain the valuation at a flat or above what they were expecting, those companies might not be around anymore because nobody wanted to fund them. So, it's often survive or die. And I think the ones that did take a realistic approach to valuation, understanding that, it was a pretty aggressive bull run for a while there. They're pretty well placed now to look at a capital markets exit.
Yeah, that's really interesting. I want to shift gears a little bit now and talk a bit about how M&A and IPO might interact with each other. So your combined skill sets cover both IPOs and M&As. I'm curious to get your take on how these two strategies might enable or impact each other for late stage founders. Where can they perhaps complement each other, and where should they fit within the life cycle of a company?
Michael, it's probably one for you, I think.
I think, I'm sure we'll both have stuff to say on it. If you think about M&A as a strategy for the IPO candidate, that as a sort of substitute for organic growth, ultimately. And, what are the growth expectations of the business? Because it's like, in very simplistically, there's sort of two different kinds of IPO candidates. It's like a dividend yield candidate who is already profitable and is throwing off money. And, people look at it as a kind of, well, I'm sure growth is always a part of it, but it's something that throws off cash already. And then there's like a growth stock, which has got a long way to go. And it can be quite capital intensive in the early years to build out what he wants to do, might not necessarily reach break even for a while, that kind of thing. So if you want to do M&A rather than organic growth, that is, or can be a sort of core defining characteristics of which side you fit in. Because if you're still looking at M&A as a sort of differentiator in terms of your strategy, it looks like, you could be perhaps more in the sort of dividend yield kind of stock, or you're, like when Meta, Facebook or Instagram, you're like trying to grow into different channels and that kind of thing. So it's quite interesting from a strategy perspective, what it actually implies. And there's a big impact on the preparation because of, we were involved in an IPO on NASDAQ earlier this year, and they wanted to do a big acquisition in the US in order to help, reshape their equity story. So they looked and felt more like a US business was one of the, rationales for doing it. And that enabled path through a US IPO. There was lots of other reasons why they did it, but it, made lots of sense commercially as well. But it did enable them to pivot into that kind of structure because they had a lot more of a revenue footprint in the US, and so were able to more credibly tap US investors. Because it is very difficult if you're a pure, European company without any US footprint or material revenues really to attract the attention of US investors in the US IPO. So that is one, strategic route that people can use. And I think, when you're doing that, it does affect, your equity story, how you're presenting your business, the financial track record. You need to look at, the integration challenges that come with big M&A, what happens to your metrics, IFRS, non-IFRS metrics, that kind of thing, which is a challenge because investors might want to see, well, how have you integrated that business? What's the 1 full year financial period where how do they perform together? What's the synergies looking like? How they've been executed? The new targets for the business look like? So there's for material M&A, there's a big reboot of the whole equity thesis and execution that's generally needed, which could delay your IPO ultimately, or it could supercharge it and enable it if you do the right acquisition. And, doing M&A quite close to an IPO, if you're listing with quite ambitious targets, you could potentially miss those targets more easily because you're not necessarily in control of all the levers as you'd hope. And if you miss targets early on after listing, that can be an issue for the selling shareholders because they might have to hold longer because they might not be able to break their lockups, or the aftermarket performance where sell downs in a way that particularly private equity would want to sell down quite quickly. So after as much as they can, because ultimately private equity looking to get out 100%. So there's quite a lot of competing factors then, if, you end up with doing lots of M&A, then you're in kind of complex financial history, it's called, which is a big sort of challenge from the pure financial reporting stuff you need to do for an IPO prospectus. It just gets more and more fiddly to get the numbers across the 3-year track record all consistent with one another with different accounting policies and metrics and that kind of stuff, which is a real headache for reporting accountants and the lawyers like us, but and for the company as well, right? Obviously, but it is really, yeah. So I mean, M&A is obviously a really fascinating part of it, and on the other side, there is, do the investors want to sell the business or IPO it, and that's the kind of dual track debate. So run both in parallel. How much of a dual track is it really? Is there ever, do you have bias one track or the other? That kind of thing. So there's lots of interesting debates around that, particularly with founders who, are gung ho on the IPO and really keen to see that. But you can have, private equity sponsor who's much more thinking they'd rather sell it, and not going through the IPO process, just because of you burn a lot of calories on an IPO, and running them both in parallel is difficult.
I think it's really interesting what you mentioned about thinking about, like, if you are planning an IPO in the medium term, like, even though on face value, like a strategic M&A might look really positive from like a competitive advantage or a market, penetration perspective, it actually creates a load of extra work behind the scenes that then, might actually delay the IPO that you might not have even considered, right?
Yeah, I mean, you just have to approach it with your eyes open, and probably throw some extra money at it in terms of resourcing and external consultants and that kind of stuff to make sure it really works, just to make sure that you don't prejudice your IPO. Yeah, it is. I've been involved in a number of transactions where there have been complex integrations going on, and it can be tricky to get everything aligned.
Makes sense. Let me throw this next one to you. Oftentimes with earlier stage companies, VC-backed companies, they have quite aggressive growth expectations. And then if you're looking for that liquidity event later down the line, one of the key things that people need to bear in mind is about having the structural compliance in place to make sure that is a relatively straightforward process. You're not having to rebuild the company from scratch when you get to that point. How should companies kind of think about balancing those two things?
Yeah, so, sometimes I guess you can see them as competing interests, but in the venture capital world, I guess you still operate on that ethos of move fast, break things. And then when you come up to an IPO, you're then told to be extremely compliant. So there's a disconnect there, let's say, in terms of what expectations are, I guess. We always see companies coming through at a much earlier stage at, Series A round, where we always call it naughty teenager syndrome, where, the company has not been maybe as compliant with GDPR or data protection laws or whatever it may be, but that's generally just a function of money. And that can be remediated through those funding rounds. It's more if they are actually doing something which is a business model fundamentally divergent to the law or whatever it may be, that's where you're going to have a really sticky IPO later on in life when you start warranting how the business was built and how it continues to operate. And I think you've seen a number of companies coming out of the earlier vintages in the kind of mid-teens coming up to IPO, having to remediate a lot of their business model prior to an IPO. Or things have been picked up as part of that diligence exercise. And I think that was a function of those companies during that vintage being, aggressively pursuing growth as well too. Whereas the discussion has really changed into how are you going to build a pathway towards profit and that sustainable float, let's say, that every dollar you create is, going to be self-sustaining to build the business. Yes, growth works very well, but it can create some bad habits as well too. And if you don't have that eye on profitability over the long term, you're going to have to eventually at one point or another have to return and do some surgical operation to adjust for profitability. And these are all things that you're going to have to do prior to any type of capital markets transaction. Although some markets take a different view as to, we were talking earlier that, New York's great for a growth company. And we're trying to change things here in the UK. So it's a tough discussion. And it is something the lawyers frequently have with the companies as to, these things need to be remediated. And any good venture capital house will be coming into the cap table and saying, these are the things you need to do to get you in a decent form for a decent exit in due course. And we see crossover rounds is what they're called as well too, often in the life sciences sector, where you're starting to bring public market investors onto the private company's cap table to get them familiar with the company, but also to bring that rigor of an expectation of a Fidelity or others on that type of cap table. So it's all to say it comes down to management ethos probably and what they've been really encouraged to do. If there's a gap in the market, for sure, go after it as you should and aggressively. But you should have, I know we'll sell our own book here, but you should have a good group of lawyers, at least in your ear the whole way through to try and at least, keep things within the guardrails that everybody be happy with.
Yeah, I think that's a really interesting, you made a few really interesting points there. I really like that idea about bringing someone from because you said earlier, you've got different types of investors that might have different perspectives on valuations, right? You've got VC companies that might make, there might be a funding round that actually is driven by not the company valuation, but other elements that might be it might be a function of other things that are going on. You need another board seat. And I really like that idea about bringing someone from outside of the VC world onto the board to help you kind of set the pathway really to that IPO.
Sorry to jump in, but it's not uncommon to reserve some of your board positions for non-executive directors with people who have genuine chops in certain areas that might be useful for you. And just, I think it goes to a fundamental point for founders is, are you bringing in people who are going to just support what you say, or are you bringing in genuine expertise and people who are smarter than you in areas that you don't necessarily cover? And the latter are the companies that I think just perform much better. So we always suggest there's at least a couple Neds sitting on any type of board, especially in that IPO preparation phase.
I completely agree. People definitely do look to diversify their cap table if they can in the run up to our IPO with, as Dylan said, these sort of crossover public market investors. And you can see pre-IPO cornerstones coming in as well. Although that, not super common here, in other markets it's very common and, getting more common here. And that's a way to try and de-risk an IPO as well. If you've got 25% of the book covered with one investor coming in and that kind of thing. I think a lot of the success on that goes if you have crossover funds in the book and you create this regular dialogue with investors through the public market investors through early look meetings and that kind of thing as you go through the later stages of the cycle to pre-IPO, then that will only help, you build confidence with public market investors and, help to try and de-risk the IPO as much as you can. Because I think, what you want is just on valuation, you want real-time valuable feedback from public market investors on what your valuation is based on how the portfolio company is performing, which you'll only get that if you have regular dialogue with them.
Yeah, I think that makes total sense. When you're bringing on your late stage investors as a later stage company, you're not just getting the capital, but you're also getting the knowledge, expertise, and the insights and everything else from those crossover funds.
And that's just something I mentioned earlier. This sort of private IPO concept is a sort of step forward on that, which is where you sort of institutionalize a sort of annual funding round with a sort of almost like a club deal of sovereign wealth funds, public market investors, sort of 3% or 5% a year, just to diversify the cap table again and again every year and almost become like a listed company. And then make that transition, the big step up to the public markets, much more, much less of a scary leap, and potentially doing annual reports before you necessarily have to, that kind of thing, just to get in the groove of the reporting applications that you have when you're listed as well, which can be a challenge.
Yeah, that sounds really smart. All I wanted to get both your perspectives on something else now. I know that having spoken to you both previously, it's obvious that due diligence is a really important piece of going through an IPO. What are the key things that you would suggest that people think about before they embark on this journey?
So I think there's all the skeletons will be uncovered basically, because it is very rigorous, from particularly the underwriting banks, and their counsel will, and the company counsel both be issuing, US disclosure letters which say there's no emissions in the prospectus, and that is a really high standard of something for lawyers to stand on. And there's obviously diligence, lots of other spheres as well. There's reporting accountants, we have lots of financial diligence and that kind of thing. So there's a huge, it is basically everything is up for disclosure, and then you have to synthesize that and put it into the prospectus. So, as Dylan was saying, historic issues that need remediating will hopefully all be revealed in this process, particularly material. So it is, a one-off opportunity really to get everything out there, and you can disclose that in it's the section of the prospectus called your risk factors. If you have specific historical issues or inherent risk in the business model that need to be disclosed and things like that. Obviously you need to do it in a way to understand, but it is ultimately, the opportunity to kind of, if you are selling, the underwriters are super invested in making sure, because they, have reputational risk and other issues, certain markets, US, in terms of liability, the directors are obviously on the hook as well. So you need, everyone's interest are very much aligned in making sure the disclosure is complete and everything. But and that's one of the reasons why the process is as involved as it is. Also, the regulator, either the FCA or the SEC, will also be casting their eye over the prospectus and asking questions in order to prove it.
And everybody appreciates there's sector specific risk factors as well too. So if you're a life sciences company, it might be, drug development pipeline is, a risk of not getting through a certain trial. Or if you're in a, heavy industry, that there might be ESG or pollutant risks. So it's just for investors to go in eyes open, but people do appreciate that each business does have its risk, and they're not there to take a judgment on. You can invest or not invest off the back.
It's a very well-trodden path to proportionally disclose stuff and go through the process. It's just obviously for every company, you only IPO once, hopefully, in theory anyway. But so it's obviously a big thing for people to go through when they're actually doing it.
Yeah, 100%. And so given it's such a big undertaking for a company, I'm guessing getting the right people on the team to begin with is a really crucial part of this.
Yeah. So some companies, they get IPO consultants on board to help them manage some of these things. But yeah.
Yeah. Are there any roles or functions that are most commonly overlooked in your eyes, Michael?
I think the pressure on the finance team is acute. I've not known any finance team with an IPO to survive an IPO unscathed, if you know what I mean. In terms of retention and attrition, it's a very demanding process. Just to step up from only thinking about EBITDA to thinking about earnings per share, and working out what your reporting metrics are going to be under IFRS and non-IFRS, all that it's just and then all the comfort package with the reporting. It's a huge exercise. So I think scaling up your finance function and COSEC function is critical. Having the right bandwidth there, and an IPO consultant can be a good, person to help with that. And also there's, independent banks like Lazard, Rothschild, people like that who do help companies on that kind of thing as well in terms of prep, as well as all the investment banks, and also having a good lawyer is helpful as well.
Absolutely.
Yeah.
Perfect. So I know a lot of the listeners to this podcast are kind of from mid to late stage kind of VC backed companies who might not have done this before. I'm curious to get your take on what a typical like 12 to 18 month journey would look like on the road to IPO? And what are the key things that you should be thinking about to begin with? You mentioned getting on IPO consultants. What are the kind of hurdles should people be thinking?
I mean, I think having the right team early to give you initial advice, I think, because what you've got to do is do a lot of things in parallel. And there are certain stages along the way, and some, people are sort of keen to get feedback. So you've got to craft the equity story. You've got to pair the company structurally. You've got to think about what does your bank syndicate look like? You've got to think about who are the target investors and, what's the targets of the business, and everything like that. And then you've also got to run the business at the same time. So you almost, it's like a job and a job. And so you've got to think about how you execute that internally. You're going to have one person who's doing it dedicatedly. So the CFO are they going to be in charge of the IPO, and CEO takes on some of the CFO's job for that time? And so it's like, you've got to think hard about the extra sort of home team and the process. And then, there's just, for the project management side of it is, you've got to collate every single material contract in the business, put it in a data room. That's a very quick thing to say. In the UK, you've got to verify every statement in the prospectus, every material statement, obviously that, not every statement, but it is a large chunk. That's something very easy to say, but takes a team of people and a lot of documents, a lot of hours behind it to do that. And similarly, on the reporting accountant side, there's lots of huge amount of work as well. So it's just sequencing it, planning, understanding the milestones, because you got to start 12 months out and then think, and then also you got to target a window, because you can't just IPO whenever you want. There are certain windows in the year when you can, only when you can IPO. The financials go stale after a certain period. Certain amounts of accounting comfort, all that kind of stuff, in order to be delivered at the right point at the right time. So you can only IPO like 2 or 3 times a year. So you have to work backwards from there, really. And then also some people do like let's redo the website, let's rebrand, let's think about, is this refreshing board to get public market, INEDs on board and that kind of thing. Let's rewrite all of our policies for a listed company. Let's put in place a share incentive scheme. There's a huge amount to think about that you can prepare for. But if you plan it and get the right advisory team on board, it's definitely all doable. And the key, in my experience, really is to try and have fun during the process as much as possible, because ultimately it's a kind of consensual thing. Everyone's interests are aligned. The banks want it to happen. All the advisors want it to happen. The shareholders want it to happen. So it should be, it's hard work, but, but it should be enjoyable at the same time, because it's not an adversarial situation. So that's, from a cultural perspective, it's key. It's important to maintain your culture whilst trying to do something as difficult as this. So you've got to have, my view, you've got to have fun whilst you try to do it.
Yeah, I think that makes sense. I'm sure some of the finance team who are kind of under the cosh at the last minute, they're not having that much fun.
So when I was pricing a very large IPO in London a few years ago, and we had this Pathfinder version, which all the numbers were blocked. And so it was like 2:00 at night, and we were all getting the numbers populated, and we decided to decamp to a local bar and get all the junior lawyers to ferry us marked up versions, which we went through in a bar in Shoreditch, and then send them to the printers to get finalized. So it's possible even for the finance team to have fun at the very last minute. Surrounded by very bemused hipsters in Shoreditch, wondering what the hell a bunch of suits are doing in the
Awesome, I love that. From obviously, there's a lot of work that goes into the planning and like the getting your house in order to IPO. Let's say for some reason you're in the middle of that, and then something changes at the last minute with the market, something changes in the regulation, or something else happens. How easy is it to then just leverage all of that hard work you've done into like a different type of liquidity event? Maybe you go to private equity instead. Is a lot of that just easily lifted and shifted, or is it like a completely different process?
I mean, you you can never bet on an IPO happening until you price. It's it's never certain until that. So there's always an element of uncertainty. People always still think about the plan B. Ultimately, people are always thinking about the next window. I mean, you can have, Ukraine war, stuff like tragedies like that, right? And people are trying to launch IPOs in that market.
But funny you say that, Mike. I literally had one IPO launched, the day of the invasion. So, it was huge concern, whether it was going to get listed.
The markets are quite resilient. But ultimately you want to get the right price for your share and think about the aftermarket as well. So, you can definitely pause stuff and dust it off 6 months later and just refresh, bring down, get a new set of, interims reviewed. If you need to, by the reporting accountants or another year-end audit done, and bring down all the disclosure in the prospectus. That's a chunk of money, but it's easier to do because everyone's geared up and understands the process and what they've got to do. So you're just sort of repeating the exercise. So you can definitely hunt an IPO. I think pivoting to a sale. I mean, basically you just turn your prospectus into an information memorandum and to do an auction process. You've got your legal financial data room for the underwriters council and the company's council and the reporting accountants. Like, you can just scale that back and turn that into a more proportionate M&A data room, because you wouldn't disclose everything. You disclose an underwriters to an IPO, so you create a more bespoke one. So it takes a bit of work to do, but it's definitely you can pivot, and that's what a dual track is really, where you've got you're running the two processes in parallel, and you're kind of leveraging from the IPO track and using that stuff. So the financial DD report will look very similar to some of the accounting financial stuff that's being done for the IPO. So there's lots of synergies between a dual track and between M&A track and an IPO track on a dual track transaction. So you can easily pivot if you're just doing only an IPO, pivot to a sale. Most people tend to, if the IPO is public, if you put your head above the parapet and people are aware of it, most people are aware of assets that are likely to IPO. But if you have actually gone public and there's kind of discussions about valuation, I mean, that means your IPO is kind of setting what's like a ceiling to your M&A price at that point, which people might need to go back and kick the tires on the EBITDA performance, or, do an M&A transaction in the US to try and differentiate the story a bit. But there's some knock-on consequences. You can't just flip immediately if you're kind of visible. And this is all the kind of stuff that the private equity community think about quite carefully, obviously, to monetize their assets. But yeah, it's all doable. And we've seen every conversation, obviously, because the markets have been pretty choppy.
Again,
sorry, I still don't understand.
I said it's a function of money and how much you have of it. Yeah.
Yeah, makes total sense. Just a couple more questions for me before we wrap up. One thing we've talked a little bit about is the difference between the London Stock Exchange and the NASDAQ and other listings you can do. What are the key kind of things to bear in mind for a company that's thinking about, should I list here, should I list there?
Yeah, it's a great question. It's very topical. Endlessly debated, right? Historically, people used to avoid the US like the plague because of the liabilities attached to it. And, with Sarbanes obviously was introduced, all that kind of thing, which the US was perceived to be much more onerous, because you could list in London, you could still list in London and tap US investors. That's called a 144A offer. That happens every day of the week. So you can have the best of both worlds. And then over time, there's a perception that, if you're a tech stock or you're some kind of growth stock, just given the success of the West Coast and how deep the US capital markets are, those performances are just really strong. And obviously the US economy has grown better than Europe since the financial crisis generally. So the kind of share prices of those companies have performed sometimes better because they've got a better growth to the home market and that kind of thing. So there's lots of factors in terms of liquidity, what's the daily trading looking like? What's the aftermarket performance looking like? What's the IPO pop looking like? The US have just got it sorted because they've got a lot of tech companies that are high growth. They value growth. They've got a big retail participation. As I said, in UK or Europe, we've kind of, and this is something that applies across the board. The number of listed companies has gone down a lot. That applies in the US as much as here to the UK and Europe. But in the UK, there's a perception that liquidity is a bit less. The research isn't there for tech companies. Perhaps growth companies don't get the right valuation because people want to see more dividend stocks rather than these growth stocks. But that whole perception is changing, and the London Stock Exchange did a lot of research and about these sort of dispel some of the myths between New York and London. Because if you strip out sort of Teslas and the Netflix and the Metas, Googles of the world, the average liquidity of your average US stock versus your average London stock is about the same. I think it's marginally higher in London for some. You look at the performance, the performance of US companies aren't strong, but if you get a UK company and you list it, what's the performance of that? And generally the performance is pretty poor, like very poor, particularly during the SPAC boom. I mean, all the Kazoo and others eviscerated. So you've got to think about what's right for you as a company, right? And as I said earlier, if you don't have much of a revenue track record in the US, your market cap is below like 10 billion. You're not going to have much brand recognition. US investors aren't really going to be that interested. You just be, 3,000th or whatever you would be on the my list of market cap. You'd be pretty anonymous company, subject to, onerous US litigation, class action environment, directors and liabilities insurance is multiple times, but it's London for a reason. And so, it's a different market, right? If you're the right company, it can be amazing. Like Arm, there's only so many Arms, and Arm would have been successful wherever it is, if I'm honest. So the US is, I think, an amazing capital markets, but I think it's probably, London's reforms will really help, I think, reweight the regulatory balance. And then I think, hopefully companies will look at the UK, given there's enough blue water since Brexit, kind of got a stable government majority and all that kind of stuff with a renewed, enthusiasm, just given it's a relative thing, right? In terms of geopolitics, the UK could have a pretty long moment in the sun as a kind of independent global financial center that isn't part of any of the big blocks, as a kind of stable Wimbledon-esque situation, which I think would be the right outcome, right? For London based on where it is today. And I think, as some of the rumors about Sheen looking to list in London demonstrate, there is demand for deep capital markets, which London not. I mean, there's no other, in London's in terms of like the depth. I mean, London's raised more money in the secondary market in terms of rights issues and equity offers the whole of Europe together basically in this year. So it's like a very successful capital markets, and his only competitor is New York. And so that's the way we should look at it. It's a very effective market. And what I want to see it be as good at tech for all the kind of VC companies that Dylan and I look after as well. We want to see them listing in London, because that's for the right place for them to list.
Yeah. And tying it back to some of the things you mentioned at the start, some of the reforms that are coming in should hopefully make that more attractive place for some of these tech companies to
Exactly.
list. And
and there's reforms on research and the Mansion House and everything. We're trying to help the buy side. So everything is trying to try and reboot the system, and get it back to what it was. Because obviously, UK was a phenomenal place to raise money and grow business on the public markets. And we've got the second best VC market in the world, as was announced. One of the people announced at this big conference called the Capital Markets Industry Task Force in London on Friday, that the UK has got the best private equity market in the world. We've got the second biggest pool of pension savings in the world. There's no reason why we cannot have, as good a listing venue as New York and as flourishing as New York. And so I think we will. I think we will if we continue to push on this big reform agenda.
100%. Dylan, Do you have anything to add? I know Michael's given a fairly comprehensive breakdown there.
No, I was enjoying it quietly. But no, I think what one of Mike's main points is, and we're much in agreement on this, is yes, the US is very attractive and we're all for that. Life sciences companies, there's a very well trodden path of heading towards NASDAQ. We totally appreciate that. It's taking an honest look at your company and understanding what is the right venue or pathway to exit for your company and being very honest about that. So I think we're in the habit of, your German company, it might be Frankfurt, frankly. No pun intended, but it's, we're trying to keep companies in the venues which make the most sense for them, where they will have the most support going forward. As Mike said, if you don't have a US story to tell, it's going to be a very difficult list for yourself to start looking at a New York exchange. So yes, you can complement that with some M&A or organic growth in the US, but if your principal business is elsewhere, you really need to be a monster of a company to start looking at going overseas. Whereas home jurisdiction will really support you, is what our hopes are, especially with the reforms. And, there should be new private capital to bring you, because this is also the larger issue as well, too, is we just haven't had as much growth capital. And that has been supplemented over the last 10 to 15 years by US capital coming in to help companies in the UK stay private for longer. And obviously, when you have a number of US investors on your cap table, or North American investors, and this is no fault of theirs because I'm very supportive of it, but obviously your direction of travel will be more geared towards North America, right? So, again, it's kind of a final point, is just be honest with what your company is and what the go forward is. And now hopefully there's enough support within the UK ecosystem to keep you home.
Yeah. I mean, it's like historically, isn't it? Think about, all the UK pension funds investing in Google. Google then, buys DeepMind in the UK, and, we have subsidized the cost of capital for Google because we've lowered it because of, invested in it. And then they bought and made a success of, the UK's leading AI, company. And so, in theory, it'd be good to see more UK, still at this point, UK investors supporting companies through that scale up, because then they can then naturally list in London. I think that is a big missing piece of the current jigsaw.
100%. Listen, Dylan, Michael, I've really enjoyed the conversation today, and I've kept you a bit longer than we initially anticipated, but it's been a lot of valuable insight here. Before we wrap up, I just wanted to get both of your perspectives on one thing. What would be your top tips for a company globally expanding, currently thinking about potentially an IPO on the horizon? What would your key advice be?
Mike, go ahead. You can.
Yeah. Keep it fun, basically, but I think I've already said that.
You can say it twice.
Did I say it twice?
I would say, just make sure the coffers are full, because a lot of people have tried to expand very quickly on limited budgets. Make sure you're well prepared as to what entering even one jurisdiction means. It's, there's a lot of unknown unknowns that will crop up, and make sure you just have that adequate buffer and the support internally from shareholders and board for those decisions.
Makes sense. Perfect. All right. Thank you so much, Dylan and Mike. It's been great to speak to you today on the Global Workforce Podcast.
That's great to be here. Thanks for having us, George.
I really appreciate it. Have a lovely day.